Good morning, everybody. Welcome to one in our series of the Economic Breakfast, Bring Your Own Breakfast. I am going to make a start, but very, very unusually, certainly for me, in terms of public speaking. I just want to say something this morning, and I want to say that your chamber, and I'm sure every one of you here in the room today, your Chamber of Commerce stands against the horrendous racism that is being targeted at our young footballers following their amazing performance at our Euro final. And I continue to see that racism played out in the media and on our TV. And I just wanted you to know that that I personally and your Chamber of Commerce is appalled by it, and we stand against it. So there you go. That's quite an unusual statement for me, publicly anyway. So good morning to everybody. It's lovely to see such a great turnout this morning to our economic breakfast. We have some fabulous inputs from Sunny from our County Council, Suren from our British Chambers of Commerce, and from Steve, Prime Accountant, and our collaborator on our quarterly economic survey. I know you've heard me say this before, but I'm going to repeat it. The quarterly economic survey is so important to us. It's a tool that we use to influence and lobby into local and national government. It actually helps us shape at the local level the kinds of business support that gets offered to our local business communities through the Growth Hub and through obviously the Chamber of Commerce and others. And it's a very, very valuable tool when we talk to national government and of course have an ongoing dialogue with the Bank of England. So I know you all do, but as I should, the usual plea is stick with quarterly economic survey. Please return your QES. It's valuable data, real life data, and we do absolutely use it on your behalf. So my co-host this morning is Sean. You'll all know Sean, the head of policy at Coventry, Warwickshire Chamber of Commerce. And Sean will be hosting the Q&A and the discussion session a little bit later, which I'm hoping will be quite lively. Please, as always, use your chat function, raise your hands. So make sure that we're hearing your views, if not in person, but in the chat box, because again, listening to your views, hearing your views, exploring your views with you is always a fabulous way of us picking those up and taking them in terms of our lobbying and our influencing and our shaping of the support that we give to local businesses. So Sean has asked me very briefly, just to give my thoughts on the economic outlook and the political outlook at the moment. And my thoughts are, and I hope most of you, all of you might agree, that of course we are seeing an improving economic position. Why wouldn't we, when we are starting to see, we are seeing the economy across Warwickshire and obviously across the UK opening up. I hope, like me, you're certainly feeling and seeing the buzz back in our city and back in our towns, not least helped by that window of opportunity called City of Culture, which is fabulous, but actually by also some wonderful investments in our city and our town centres. So we see the improvements happening in and around Cov City, but we're also seeing and hearing of some really fabulous investments in our town centres such as Nuneaton, and more recently through our local enterprise partnership, I was delighted to read of the work that Warwick District Council want to do in terms of investing in their creative sector in Leamington Spa. So all credit to them. And those investments are really important because they're almost a little bit of a showcase. They're a showcase of our resilience. They're a showcase of how we as partners and as businesses in Warwickshire intend to continue to invest in our local communities and showcase that to the rest of the UK and indeed the world. Challenges, of course there are challenges in terms of economic challenges. I have to say, I think they're very sector-focused challenges now, sector-led, and the challenges are different depending what sector you're in. And again, it'll be interesting to hear whether that sits with Steve and Suren and Sunny, and of course some other people on our call, on our meeting today, not least our colleague from Lloyd's. I think they're sector-focused, and that's because we know that the hospitality, tourism and leisure sector continues to have a tough time. It will probably never have the opportunity to make up the loss of those revenues, of those incomes that they've lost throughout the pandemic. And as we continue to go forward working with this pandemic, And then if you look to the manufacturing engineering sector, I hear a very different noise. And that noise is more around essentially the transition from the EU, disruption in supply chains, huge hikes in prices, which of course impacts on costs. Those costs can't always be pushed then down in the supply chains or in the customer chains, and the delays at our borders and the cost of the bureaucracy that still comes if you are certainly importing or exporting across Europe. A positive, we're seeing a real boost, by the way, in our exports from Warwickshire, with our exporters not just looking at Europe, but looking much further afield, which of course is fabulous. Another positive, and again we'll hear from our three speakers in a moment, is that we are seeing an improvement, a growth in workforce predictions. That's fabulous, but again, as some of my colleagues on this event this morning know far better than I, such as Sally from Warwickshire Chamber Training, we also know that employers are experiencing, which is so odd really, but are experiencing huge recruitment challenges. And I say that's odd because of course we've still got quite high unemployment that was caused by the pandemic. And again, it'll be interesting to listen to our contributors around why some of those recruitment challenges are definitely in existence at the moment. When I look at the political landscape, I just turn to the fact that we've heard from our PM, our Prime Minister, about the opening up of the economy on Monday. We've all been calling for clarity on that opening up, but I can tell you, I can promise you that as of very late last night, Sean and I were privy to some documents that came out from government. So we were given a first-hand opportunity to have a look at them. Hopefully they will come out publicly, if not very late last night, today or over the next few days. And those documents are an attempt to give guidance to businesses, to employers on essentially the government saying, well, yeah, the gloves are off, we're opening up, but we all know, don't we, in business and in the public sector, we all know that we still have to manage our way through COVID. We have to keep our people safe, the people that we employ, keep our absenteeism levels low, keep our productivity levels high, and therefore you will see some government guidance come out. She says, not sceptically, but she says sort of for what it's worth. It does remind us of the obvious, you see, I think. It reminds us that it's all about keeping our workplaces COVID safe, cleanliness, sanitisers, masks if we're encouraging our staff to still wear masks, good ventilation where we can have good ventilation, and most importantly, I would urge all of us to carry on with those all important risk assessments. And if you're not sure how to go about doing risk assessments within your business, again, we're here to support you as your Chamber of Commerce or Chamber of Commerce Chamber Training, and they can work with you on those kinds of things. So it will be interesting to see as the gloves are off. I should probably say that's probably not the right phrase, but as we truly open up the economy, as we go into the summer, I think we're going to see a great summer. The temperatures are looking good, which means that we will see those birds in our towns and our cities. I think certainly Warwickshire will really benefit from that because it is a place to visit and it is a place to stay. I think our city will benefit from that because of the fabulous work that's going on every single day in terms of our City of Culture celebrations. So fingers crossed, I think we have an awful lot to look forward to. So that's it from me. So now I'm going to hand you over to Sunny, and we're going to have a little look at the data when it comes to our quarterly economic survey. Is that okay, Sunny?
Yeah, that's brilliant. Thank you so much, Louise, for having me on. There should be some slides on their way now. Brilliant. Thank you, Sean. Yeah, so good morning, everyone. My name is Sunny. I work as a senior economist at Warwickshire County Council. So this morning I wanted to give an overview of the latest quarterly economic survey results for Q2. We'll cover obviously the overall economic outlook for both the local services and manufacturing sectors and how it's changed in Q2, alongside looking at the domestic and overseas orders indexes, the employment index, cash flow investment index, and also the business confidence index. Yeah, so next slide, please. Brilliant. So before we go ahead, it's important to bear in mind that the index scores that make up the QES are similar to those used by the Purchasing Managers Index, so the PMI nationally. And so the index value of 50 is balanced, and anything below 50 suggests most respondents feel pessimistic or negative, and anything above 50 suggests that most respondents are feeling quite positive or optimistic. Next slide. Thank you. So looking at the overall economic outlook shows a positive move for businesses in Q2, with the index pushing further above that 50 mark for the second consecutive quarter in 2021, suggesting that businesses across Coventry and Warwickshire have remained optimistic since the start of the year. Q2 is actually the first quarter that we see overall economic outlook index score for Coventry return to pre-pandemic levels, and this comes as Louise said, as the economic landscape for businesses changed in Q2 once again, with the government staying true to their roadmap of gradually opening and unlocking the economy in April the 12th, with April 12th seeing the opening of non-essential retail, hospitality, amongst other personal care premises and leisure facilities. This is kind of combined with the rollout of the national vaccination program continuing its or gathering further pace as well in Q2. So these two factors combined have given businesses some well-needed kind of hope and clarity in terms of their economic outlook, and also this is reflected for the most part in the components of the overall economic outlook index. Next slide, please, Sean. Brilliant. So yeah, firstly, looking at the domestic orders index. So the domestic orders index in Q2 had contrasting results for the services and manufacturing sector. So the services sector saw an increase to 59.5 in Q2, breaking past that important 50 mark, with both current and advanced orders also increased well beyond that 50 mark, mainly as a result of the majority of the service sector being allowed to open up, and the pent-up demand that came with that as well, as the long periods of time that they were closed. So on the other hand, the domestic orders for manufacturing fell slightly to 51.3 in Q2, with a slight fall seen in both the current and advanced orders. This is likely to have come as a result of kind of the well-documented raw material shortages, and leading to kind of increased prices, and obviously being less competitive prices amongst manufacturers perhaps. Next slide, please, Sean. Thank you so much. So yeah, looking at the overseas orders index or exports, this is contrasting to Q1. The overseas orders index for both the local manufacturing and services sector saw a rise in Q2. So overseas orders index for the service sector increased to 43.5 in Q2, with the current orders index seeing the largest increase. And once this is likely due to kind of the global vaccination rollout, allowing businesses globally to reopen as well. However, the overseas orders index for the service sector still remains below that 50 mark. Contrasting, however, the manufacturing sector saw a significant increase in overseas orders to 57.1, with an increase seen particularly in advanced orders. And obviously this may come as the transition settles somewhat, and we see that global exports increase as well. So yeah, next slide, please, Sean. Brilliant. So yeah, looking at the overall employment index, so the labour force index, in other words, this is made up of how the labour force has changed in the last 3 months, and how businesses feel it's going to change in the coming 3 months. So the employment index paints for a positive picture in Q2, with both sectors experiencing significant positive movements in their index scores. And the overwhelming majority of respondents from both the services and manufacturing sectors suggested that their labour force had either increased or remained constant when compared to the last 3 months. And similarly, the majority of respondents also suggested the same when asked about how they feel about the labour force in the coming 3 months. So this optimistic outlook on employment within Coventry and Warwickshire is reflected in their individual index scores, with the services reaching 55 and manufacturing reaching 68.6, so well above that 50 mark. So there's certainly somewhat of a revival in the local labour force, or at least certainly the QES survey results allude to an employment revival. Next slide, please, Sean. So looking at the cash flow and investment index, this had increased once again for both local sectors in Q2, breaching that 50 mark. The local service sector saw an increase to 52, with 60% of businesses suggesting an increase in the cash flow, component. This is unsurprising, obviously, as the loosening of the restrictions and the reopening of the majority of the service sector helped to boost those cash flows. The manufacturing sector continued its upsurge in the investment and cash flow index, increasing to 60.5 in Q2. Once again, that cash flow component driving the overall increase once again. So yeah, the cash flow aspect of the index has definitely seen an upsurge for both sectors. Next slide, please, Sean. Okay, so yeah, looking at the business confidence. So the loosening of COVID-19 restrictions alongside the mass rollout of the national vaccination program has played a significant role, as mentioned above, in boosting business confidence amongst local businesses. So both local services and manufacturing sectors reached significant heights in terms of their business confidence scores in Q2. For the services, the business confidence index soared to 84.4 in Q2. This is the highest on record, with an outstanding majority of businesses reporting that they expect their turnover and profitability to increase in the coming 12 months. Despite this uptick in confidence, many businesses in the service sector indicated that they expect prices to increase in the coming 3 months, with the majority of them suggesting that this rise will come from increase in other overheads. And looking at the manufacturing sector, business confidence also reached record heights, with an upsurge to 80 as of Q2. So this comes as the majority of local manufacturing sectors expect, once again, turnover and profitability to increase in the coming 12 months, as I guess they've had a bit more clarity and from government in terms of the roadmap. However, once again, all local manufacturers that did complete the survey expect price pressures to intensify in the coming months as well. Next slide, please, Sean. Brilliant. So this graph just shows the index scores for the local sectors and how they've changed in comparison to their national counterparts between 2016 and 2021. I'm not sure how well you guys can see that, but the index for the local manufacturing sector is seen in the orange squares, and the local services sector index scores are seen in the blue squares. So just to put Q2's economic survey results into context, we see that both the local manufacturing and services sector index scores have bounced back to that pre-pandemic levels just before the dip seen in Q2, showing signs of economic recovery, as we've mentioned, as I've mentioned previously. So it does seem as though the economy is getting back on its feet and back on track. Final slide, please, Sean. Okay, so just go through a little summary of the things I've kind of had a whistle-stop tour on. So the economic outlook for Coventry Warwickshire continues to gather pace, showing considerable robustness and strength in the second quarter of 2021. Q2 was the first quarter, as I mentioned, to have the overall economic outlook return to pre-pandemic levels, presenting clear signs of economic recovery. This comes as government relaxed restrictions alongside continuing to successfully roll out the national vaccination program. The local manufacturing sector showed considerable expansion, particularly from overseas orders or exports, as the issues around the EU transition kind of settled somewhat and global exports increased. The local services sector benefited significantly from the unlocking of the economy, benefiting from that pent-up demand that we're seeing in the economy that came with the unlocking. And this has been translated in an uptick across all components of the index for services. I guess the clarity of government's roadmap and the various stages of the lifted restrictions have seen business confidence reach record heights in Q2, according to the survey data. But one thing to bear in mind is that the survey data does show many businesses being concerned with price pressures in the coming months, and perhaps we may see this being translated in quarter three's QES results. So yeah, thank you so much for listening. Happy to take any questions as always.
Thank you, Sunny. That was really, really good, really, really helpful. And before we move on to Suren from our British Chambers of Commerce, Suren, please, by all means, introduce yourself when you come on. And usually I want to take one or two inputs, if you don't mind. I know, sorry, I'm throwing it around a bit, Sean. Forgive me for that. But I'm always interested to hear from some input. So, Roger, I'm going to pick on you, as I always do, our colleague from Lloyds Bank. So we're hearing here that we've got improvement in optimism, confidence, broadly exports. We certainly see quite a strong export landscape here in Coventry and Warwickshire. Sally, I'm going to come to you as well in a minute, because I want to see what's happening on apprenticeships and whether that's helping with some of the recruitment challenges we've just heard about. But anyway, sorry, Roger, you know I pick on you because you give such, as an area director, you give such really valuable input from the SMEs that you're working with. Does some of that resonate with what you're seeing with businesses on the ground?
Hi, Louise. Yeah, good morning, everyone. Yeah, definitely. Just to give you an idea of cash, what the cash position looks like for SMEs. So I'm looking after larger SMEs, probably up from about 3 million turnover up to 100 million. And it's quite important to differentiate, because I think the smaller businesses are having a tougher time, particularly because they tend to be in the sectors that are more challenged. So, you know, my businesses have got the best part of £1 billion on deposit now and are running with growth in credit balances of 30% year on year. I would normally expect that to be about 5% growth, so it's significant. In essence, what they've done is banked the resources, banked the profitability. Some of them have traded really successfully through COVID, you know, with sort of great strategies around pivoting. And I think now there's little bit, so there's definitely some M&A activity going on, businesses being sold and purchased. There's a lot of appetite. I've seen more of those this year than ever. And that's a little bit about people thinking, I've survived, I want to sell my business and move on. A little bit about people having cash in the bank, thinking we want to grow this, we want to look at new opportunities. Very, very few failures from CBIL payments and bounce back loan payments. I know you've asked me that before, but I'm seeing really a handful. We do have a really strong client base. We are selective a little bit in Lloyds, but that said, probably if I've got 10 that are struggling to meet payments or have failed, that'll be out of 900 clients. Where do I see the pressure? Yeah, definitely the manufacturing supply chain, cost, getting goods, albeit that seems to be getting easier. There's less discussion about Brexit, and services operating profitably. So, you know, the cost of operation in the hospitality sector is really massive, and there's lots in the press about not getting staff. So their profitability is challenged, I think, and I'm surprised the confidence is as high as it is, to be honest.
Okay, thanks, Roger. That's really, really helpful. Good segue on the recruitment challenges, particularly, as you say, within hospitality. And yes, definitely pressures within hospitality, tourism, leisure. And a lot of those pressures are coming from wage pressures because of wages having to go up because they can't recruit. So, Sal, the apprenticeships were absolutely decimated, really, throughout COVID-19. Are people using apprenticeships as a route to solve some of their recruitment challenges?
Yes, Liz, I think we're seeing a more positive picture around on the apprenticeship front. We're not quite back to pre-COVID levels in terms of recruitment patterns, but over the last 3 months, 6 months almost now, we're heading towards a much more steady pattern of recruitment. We're seeing it much more stable compared to the end of last year when it was really up and down. There's a great opportunity at the moment for businesses to take advantage of the financial incentives that the government are providing. So a business can receive up to £4,000 from the government up to the end of September if they take on a younger person in that category, a new role via the apprenticeship route. But equally for adults as well, there are still some financial incentives out there to encourage businesses to consider apprenticeships as part of their recruitment strategy.
Thank you, Sally. There you go, guys. So have a think about apprenticeships as a route to solving some of your recruitment challenges. And just reflecting on what Roger said, Roger's right. Of course, there is a difference between the larger, the resilience in the larger businesses and the much smaller businesses. And it'll be interesting to hear from Steve in a moment after Suren, because of course that is a challenge for Coventry and Warwickshire. Because of our 38,000 businesses across Coventry and Warwickshire, we are on the smaller side of the smaller to medium-sized businesses. So anything that really impacts on that small side, the small business economy, really does impact on Cov Warwickshire. On the mergers and acquisitions, absolutely agree, Roger. We work quite closely with a non-exec actually of the Chamber of Commerce, Steve Twigger, Luckman's, a bit of a mergers acquisitions specialist, and I'm sure he would definitely say he's seen an increase in those interests out there in terms of mergers and acquisitions. Okay, sorry, I'm waffling on. We're going to hand you over now to Suren from our British Chambers of Commerce. Welcome, Suren.
Good morning, Louise. Thank you for the introduction. Good morning, everyone. Thanks again to Sean and Louise for the invite to come speak today. As mentioned in the introduction, I'm just going to give you a bit of an overview of what we're seeing at a national level. So this is accumulation of all the QES data from across the country and what that is showing. And also sort of finishing off a bit of a forward look, what we expect to see potentially happening over the next few months as the economy starts to fully reopen. Before I get into the results, just a bit of background really, and just to reinforce what Louise mentioned in her introduction, is that the QES survey is very much one of the leading private sector business surveys in the UK. We regularly get around 5,000 to 7,000 businesses responding to it. So that's accumulation again of all the data from Coventry, Warwickshire to right across the UK. It means it's far bigger than the other business groups such as CBI, FSB in terms of national surveys they provide. It's closely tracked by a number of key organisations like the government, the IMF, and the Bank of England always include QES results in their quarterly monetary policy reports. That's their forecast they produce. You always see QES data in there, so it's very closely tracked. And that sort of again reinforces Louise's point at the start. It's really important that we continue to get all this data through so we can influence government and national level and influence key policymakers as well. So just in terms of the specifics for the second quarter, just a touch on the 6,000 people responding to the survey. Again, the survey in terms of its proportions roughly represents the wider economy. So 3/4 of it is services. And we have, of course, have a high proportion of exporters given Chamber of Commerce membership makeup. And the last point to make is the sort of field work period. So the field work period ended on the 10th of June. So we probably missed off some of the downward pressure from the delay to the end of the roadmap, which I think was announced on the 14th. That's like cut off. So that maybe, again, give you a sense of what may have happened to confidence if that had been included in the data. So what we're seeing, so first we'll start with sort of activity in the second quarter. And as you can see from this chart, a really robust picture for the second quarter of this year. We're seeing quite a strong bounce back of a number of headline indicators. For example, we've seen a portion of firms reporting increased domestic sales up to 44% in the second quarter of this year. You can see it's quite a big jump from what we saw in the last few quarters. And in particular, if you compare to the second quarter of last year, which is the sort of due to the first lockdown, which had the sort of the down sort of point of the UK economy over the last year, that was just at 10%. So you are seeing a huge recovery. And for manufacturers, we're seeing the balance of those reporting increased sales at its highest level of about 6 years. And for services, it's at around 3 years. So again, a really strong picture for the second quarter of this year. And what's driving that? Well, in the second quarter of this year, the UK economy is in a bit of a sweet spot at the moment, because you're having a situation where you're getting the benefit from the economy reopening as you know, through the various stages of the roadmap. So that's releasing pent-up demand. At the same time, you still saw a lot of government support in place. So through the second quarter of this year, the furlough scheme is still largely in place, and a lot of the furloughs were still in place as well. And underpinning that, those two factors is obviously the rapid vaccine rollout, which has been sort of the real game changer for the UK economy, and it's boosted confidence, as you'll see a bit later, and also activity as well. If you move to a sector split, and I think Louise, the point that Louise made at the start around the sector differences, I think we're seeing that in our data. I would say overall, sectors across the economy, I've seen quite a strong improvement in the second quarter of this year. But if you look at the service sector, for example, we are seeing a bit of a two-speed services sector. So we're seeing B2B firms doing really well, we're seeing quite a strong bounce back. And we see, for example, marketing media has seen the biggest increase. Personal forms are seeing an increase in domestic sales. In contrast, hotel and catering, so consumer-facing industries, saw the smallest increase in the quarter, so it's just 38%. Having said that, when you compare hotel and catering in Q2 versus Q1, we are seeing quite a strong increase. So the figure, you see for Q2 in the chart shows 38%. In Q1, that was just 7%. So you are still seeing a strong improvement in sort of consumer-facing industries, but it's from a very low base and it's still got more room to catch up compared to other parts of the economy. The manufacturing sector, again, is seeing a strong quarter. That's despite some disruption we're seeing in the supply chain. So we're seeing a fair bit of resilience in some of the manufacturing numbers. Moving on to export sales, again, we saw a steady improvement in the quarter. You can see the numbers are broadly in line to what we saw just before the end of 2020. So a bit of a drop off towards the back end of last year as COVID restrictions came in place, but also some issues around Brexit. But we didn't really see a big drop off in the data, given some of the volatility we're seeing around Brexit. So we're seeing such a steady improvement in the data. So it's very stable. What we are still seeing, the portion of firms reporting a decrease in export sales higher than those who are reporting an increase. So still in negative territory for a lot of businesses. Moving on to cash flow, and in many ways, this is the key tracker indicator that we track in our survey, because it is a key indicator of financial health. And again, we have seen that strong improvement in the second quarter. So almost 1 in 3 businesses are reporting an increase in cash flow in the quarter, and that's up from 1 in 5 in the first quarter of this year. And that's back to levels we saw around 2018. So that's good improvement, but it's not as good an improvement as we're seeing some of the other indicators. So that suggests that there are still some underlying issues with cash flow for a lot of businesses. I think the point made earlier around smaller businesses in particular struggling on cash flow, I think that again, we're seeing a bit of that on our data as well. Moving on to the labour market, and similarly to what we saw in the previous presentation, we are seeing again a strong improvement in the second quarter, a strong increase in demand for labour as the economy reopens. So over half of businesses reported that they attempt to recruit in the second quarter. So that's quite a significant uptick to what we've seen. And if you compare again back to sort of the nadir for the UK economy in Q2 2020, it's more than double that period. So you can see it's quite a strong improvement through that. If you look at a sector level, as you can see, a number of sectors have seen quite a strong increase in demand for labour, particularly sort of public and voluntary services, but also production and manufacturing as well. Again, in sort of hotel and catering, we're still seeing a relatively, compared to other sectors, a relatively small proportion of businesses reporting an increase in activity. But it's still a strong improvement for the first quarter. So in the first quarter, hotel catering saw 20% of businesses reported increase in attempting to recruit. That's more than doubled in the second quarter this year. So again, we see a strong improvement in B2C firms, but from a lower base than compared to many other sectors in the economy. Now, with that increase in demand for labour, we are seeing recruitment difficulties across the board, really. And that's seen in our data where we're seeing around 70% of businesses reporting an increase in the recruitment difficulties in the second quarter of this year. And almost that is one of the side effects of the economy reopening in the way that it has, because in many ways, the recession that we saw last year was pretty unique compared to previous recessions in that you had both demand and supply compressed for quite a long time. And that's usually different to, for example, the financial crisis when demand was suppressed, but supply was still relatively unhit. So what you're seeing as the economy reopens is quite an uneven picture where demand has bounced straight back up and supply struggled to keep pace. And that's where you're seeing some of the challenges we're seeing at the moment, both nationally, but also globally as well, as I'll go into a bit later. And we're seeing it in some other indicators as well. And one of those indicators is prices. So as Sonny showed in his chart, price expectations have increased quite significantly in the second quarter. For manufacturing, the balance of firms reporting an increase in price expectations, it's at its highest level on the record of the surveys. So started in 1989, so it's over 30 years. Again, for services, again, we're seeing a slight pickup there as well. And that's feeding through in some of the inflation numbers we're seeing at the moment. For example, inflation figures came out today showing inflation's up, consumer price inflation is up to 2.5%, which is the highest level for about 3 years. So we're seeing that price pressure filter through into wider consumer prices. So what is driving some of that price pressures? Well, the big thing has been the rising cost of raw materials. 89% businesses reporting in manufacturing reporting that raw materials is what's driving this increase. And again, a lot of issues we're hearing around anecdotally across the country, just around rising steel prices, shortage of semiconductors, price of cardboard going up, transport costs, all these sort of things. Again, a lot of this is, a part of this is due to the fact that the economy is reopening. And again, supply isn't meeting demand because it's very much an even picture, both nationally but also globally as well. So for example, some of those countries, particularly in the developing world, who are producers of some of these raw materials are still struggling quite a bit with COVID restrictions. For example, the vaccine rollout, as we'll see a bit later, is much lower there. And again, that's hampering delivery of some of these goods as well. So, and of course, Brexit is also impacting as well. One thing we're also seeing at a national level is that rising prices isn't yet filtering through into higher pay settlements, as you can see from the charts. It's still relatively muted, which would be quite significant for the Bank of England when looking at interest rates and looking at whether some of the inflationary pressures we're seeing at the moment is transitory, or temporary, or permanent. And what we're seeing at the moment, what the data is just at the moment from the QES, is that it's relatively temporary. And as supply adjusts to the growth of demand, and as I said, supply chains start to sort of repair a little bit, we may well see prices moving back to more of a normal level probably over later this year and into next year. So we think our own view around inflation is going to be around for a little bit longer, and inflation is likely to rise above 3%, but it's going to be relatively temporary, and it may fade sort of later this year, particularly if employment starts to pick up as things like the furlough scheme starts to end. So that again is something to watch out for quite closely. At sector level, we can see price pressures are most acute within construction, and that may be due to, again, some pocketed wage inflation we're seeing in that sector, but also, as I mentioned in the previous slide around raw materials, that they're more exposed to rising in raw materials in construction. So we're seeing that through in the data, and similarly in sort of retail and wholesaling as well. We're seeing some price pressures there again, some getting to raw components. So moving on to some of the forward-looking indicators, and again, similar to the Coventry Warwickshire data, we are seeing quite a strong pickup in confidence, albeit not as strong as what we saw in the Coventry Warwickshire data. It's a bit more muted. So for manufacturers, confidence is at its highest level for about 6 years, and same for services as well. But at national level, it's still a relatively strong pickup, again, from what we saw in Q1. And when you look at the chart, 40% in Q1, up to over half in Q2. And more than double again compared to Q2 2020, which is very much the base point for the UK economy with their pandemic. So again, it's relatively strong sort of pickup. One thing I would say, and I mentioned right at the start with the fieldwork period, the fieldwork sort of ended before there was confirmation of the delayed end of the roadmap, which I think was announced on the 14th of June. So that's not accounted for in this data. So we don't quite pick up whether there's any tail off in confidence from any delay in the roadmap. And also, you're not necessarily picking up some of the recent spike in infections, and when that's impacting the confidence as well. So again, that's something that we may see in the Q3 figures. And lastly, one of the indicators is around investment, and this shows investment in plant machinery. I mean, have we ever seen a steady pickup in investment intentions in the second quarter? But compared to some of those previous indicators, it's much more muted. And maybe good to get people's feedback on this, because you expect investment to pick up quite strongly with the economy reopening, but it seems to be lagging some of the other indicators, which may be due to a number of reasons, due to maybe the fact that a lot of businesses are maybe in a sort of repair phase, repairing cash flow, for example. Also, there seems to be quite a bit of a muted interest in the super deduction incentive, and that's by the government budget. So again, interesting to get people's views on that as well. So we're seeing a slight improvement in investment, but relatively muted compared to the rest of the economy. So that's the data. Just before I sort of hand over, I just want to sort of give you a bit of a sense of where we're seeing, what's some of the factors that may drive a sort of recovery beyond sort of Q2. So there's a sort of positive and negative factors that may drive the recovery. On the positive side, we're seeing quite a bounce back from the reopening economy. So the vaccine rollout is the prime example of this, which is helping to boost confidence. and boost activity. But we're also seeing some temporary factors boosting the economy at the moment, such as the release of pent-up demand as people go to the restaurant for the first time, go to get a haircut, that sort of thing. That may fade as you move forward, but we're seeing a lot of that boosting the economy at the moment as well. And we're also seeing a lot of government support still largely in place. Again, that's also boosting activity as well. In terms of headwinds, the big one at the moment, I won't go through the whole list, the big one at the moment is sort of the surge in infections. And we're seeing Delta variant cases going out quite a lot. And it'd be interesting to see how that impacts the economy, because this will be the first time we're seeing a period where restrictions are easing at the same time when COVID cases are increasing. And it'd be interesting to see what consumer behavior and business behavior reacts on the back of that. Because the concern that we have is that a lot of the sort of recovery is going to be driven by the UK consumer as they spend some of the savings they've built up during the pandemic. Now, the slight concern is if consumers become more cautious because they're concerned about getting affected and rising cases, that may impact their sort of willingness to spend and interact, go to restaurants, that sort of thing. So it'll be interesting to see how that sort of plays out over the coming months, particularly as the furlough scheme starts to wind down and maybe we see a pickup in unemployment over that period. Similarly, from businesses, again, the picture is looking really, really strong in Q2. But again, it'll be interesting to see what the impact of both rising prices and also the staff shortages that I mentioned in the earlier presentation will have in business activity. Whether that becomes a drag anchor, if you can't find people to meet your lunch service and you decide to go to 2 services a day at a restaurant, that will impact on business activity. More generally, that happens more widely. So I think there's probably headwinds for both consumer and business activity. Again, interesting to see how that sort of plays out over the coming months. So again, this is probably the first time we're seeing this as part of the pandemic. And speaking to our chambers overseas, a lot of them are looking at what UK economy does through this period. It's a bit of a sort of a test pilot really to see how the economy reacts to both rising cases and easing restrictions at the same time. So what does this mean? What does it all mean for our forecast for this year? So we released our quarterly economic forecast a couple of weeks ago, and I won't go through all the numbers, but the headline sort of picture here is that we are expecting to see a relatively strong economic picture for this year. We're forecasting economic growth of 6.8% this year, which we've realised will be the highest growth on record. As records began in sort of just after the Second World War. And now I would sort of caution that shouldn't be seen as a boom for the UK economy. It's more climbing out of a big hole. Because if you remember, and you see from the 2020 figures, the economy actually contracted by a record amount last year. So it's more sort of climbing out of that sort of big sort of COVID-shaped hole we saw last year, rather than sort of big boom for the economy. As I mentioned in the previous slide, a lot of that's going to be driven by the household consumption. So a lot of households have built up savings during lockdown, so they're essentially forced to save, and that's starting to run down, and we're seeing that at the moment, and that'll help to sort of support consumer activity, particularly given the boost from things like the Euro 2020, the warm weather as well. That'll help to boost consumer activity, particularly over the summer. As I mentioned, investment will bounce back a little bit this year, but I think it's relatively subdued business investment for this year for the facts I mentioned earlier. We expect the investment to pick up more strongly next year, as businesses are maybe in a better position to make use of some of the government incentives like the super deduction incentive, which runs into the end of 2020, sort of the end of the financial year in 2023. On international trade, I think the outlook's probably a bit weaker. I think international trade is going to provide sort of a negative contribution to economic growth over the next couple of years. And there's a number of reasons for that. On the export side, we think that Brexit will have an impact on trade flows there. But we also think demand for UK goods and services will be relatively weak because there's not necessarily UK fault. It's actually the fact that overseas markets, such as the European market, their economy is likely to grow at a slower rate than the UK, which means the demand for goods and services will be relatively weaker. In contrast, we'll see for imports, we'll see import growth be relatively strong over the next couple of years because the UK economy will be going quite strongly. So they'll be sucking there'll be a lot more demand for imports there as well. I said that for inflation, we think that's going to be relatively tempered this year, but it'll be a relatively strong period for inflation this year. But we think interest rates will be relatively low this year and into next year as well. And we don't expect interest rates to rise until 2023. And unemployment, as I mentioned earlier, we think unemployment is going to be relatively subdued, which is certainly a good boon. So we think unemployment is going to peak sort of the fourth quarter of this year as the furlough scheme winds down, so around some 5.5% to 6%, which is obviously quite a bit higher than it is now. But if you compare to where predictions were this time last year, where we're talking about 11-12% unemployment, that's quite a bit lower, and it's quite extraordinary. And that obviously sort of shows resilience of businesses, but also the impact of the furlough scheme in limiting unemployment. And that's a huge success, really, because unemployment is likely to peak at a much lower level than we saw during the global financial crisis, for example. And given the hits for the UK economy is all much bigger this time around, that's clearly a very positive sign. Moving just briefly onto the sort of the global picture, and this is sort of one non-economic chart here, but we are expecting quite an uneven global recovery, and that's pretty much all due to the pace of COVID vaccination rollout across the globe. So you can see the UK right at the left-hand side are one of the top leaders in the rollout of the vaccine, which is actually boosting UK economic prospects. But what we're seeing from this chart is actually quite an uneven picture. And we're seeing sort of a lot of developed countries, sort of the countries in South Asia, for example, such as Korea, where vaccine rollout is much more muted. So we are likely to see a sort of an uneven global recovery based on that, because what we expect is COVID restrictions to be in place for longer in some of those countries, which will impact things like supply of raw materials or of components. And that's why we may see some of that supply chain disruption persist a little bit longer and into next year as well, because of that delay on that uneven sort of vaccine rollout we're seeing globally as well. So in summary, latest QES points to a really strong second quarter of this year for the UK economy. We're expecting growth around sort of 4.5% to 5% for the second quarter of this year. The rebound sectorally is a bit more uneven. Again, we're seeing sort of that two-paced recovery with B2B firms doing particularly well. Of course, one of the side effects of the economy reopening is higher inflation, and we expect inflation to pick up again, sort of drift up over the coming months, and we're seeing that in today's data. We're forecasting record UK GDP growth for this year, but again, just to reinforce, this is coming out of a big hole rather than a boom for the UK economy. We expect, and this is going back to Louise's point, we're expecting the recovery to be relatively even, both at a sector level, but also within locations across the UK, and also through different cohorts of people as well. For example, we think that young people may be more exposed to some of the unemployment conditions over the coming months as the furlough scheme starts to wind down. And that's it. Thank you very much. I'll hand back to Louise.
Brilliant, Suren. Thank you. And are we able to have a copy of your slides for all of our delegates?
Yeah, that's absolutely fine.
All right. I particularly like the slide around the headwinds. I think that's really useful and really useful for us all as businesses, employers in the private sector to be mindful of those headwinds, those challenges that are still coming down the line if they're not already with us, such as the EU transition. Very minded around the potential for further increases in the COVID transmission rates. Just to let everybody know, it's something that's constantly discussed at a regional level in a meeting that's chaired by Andy Street, our elected mayor, that I attend every other week. And we're constantly looking at those transmission rates certainly across the West Midlands, and what we can do, if anything, about them. And it would be remiss of me if I didn't say on behalf of our Director of Public Health at our City Council, Liz Galton, it would be remiss of me if I didn't remind us all that we have a responsibility, which I know we all know this, but we have a responsibility to try and help keep those transmission rates down by keeping our workplaces COVID secure and COVID safe. Interesting, Suren, that you comment on yes, inflation going up. I think we can all predict that, certainly with wage inflation and price hikes, but that interest rates might hold. That will be interesting, won't it, as to whether interest rates actually will hold. Probably in the short term, yes. And again, that plays back to the importance of our quarterly economic survey, because I know, Suren, that you send the UK QES, where you bring all the data together, you send it into the Bank of England to try and influence their decision making around interest rates. So that's important. So before I move on to Steve, because you know what I'm like, I'm completely reorganising Sean's agenda. Ravi, I wanted to bring Ravi in. So Ravi, you asked an interesting question that I wanted you to pose to all of us around cash flow.
Yeah, thank you, Liz. Suren, I think it's very encouraging to see the positive outlook over a previous quarter, right? And one of the things which I was wondering about the cash flow would be good if you got any insights breaking those numbers into whether the cash flow increase is contributed from the profits or sales the companies are making over last one quarter, or is it a combination of some of the supports you have, like a business loans or grants, supported with some profits or cash, right? Because the current cash flow would be good for a short-term sustenance, but having that cash flow for a long term is really good for the company sustaining long term.
Okay, thank you, Ravi. I did want to explore that because I thought that was a really quite clever, really interesting question. Suren, you might want to comment. So it's that whole issue around, is cash flow because we've been resilient and our cash in bank has come through either savings or ongoing sales, or is that cash in bank also reflective of government support, particularly the job retention scheme, as we all know it as furlough, and indeed loans? Roger, have you got a comment on that? What are you seeing in terms of cash in bank?
Yeah, so it's really difficult to define, isn't it? Because we don't have that level of data. But I definitely think there's a significant contribution to retain profitability now, and I'll explain why. So my book's grown from 980 million to 1.42 billion in the first 6 months. The biggest growth was in May and June. There were no government loans drawn in May or June. The majority of my funding was drawn actually in 2020, and that was £90 million I lent on government schemes. And in May, my deposits went up by 32 million. In June, they went up by 43 million. And that is essentially, I think, retained profit in business. And it's a really interesting curve that I don't typically see. And my lending, I am still lending. I'm probably drawing about £5 or £6 million a month. That's not government schemes. That's traditional loan schemes, typically property based. You know, my net lending, because obviously payments are coming off all the time, is staying at about 300 million. So there is a significant contribution. My customers borrow very little from other providers, so there's a significant contribution from trading, I think trading and retained profits now in May and June specifically. I will preface this, you know, we've got larger SMEs, they're 3 million plus turnover. They are highly profitable businesses, a lot of them, because we pick those kind of clients. So perhaps it's a little bit of a skew on what's happening in reality, but, you know, I'm seeing a really strong cash position May, June now.
Thanks, Roger. Yeah, I'd agree, certainly for the larger businesses. For those smaller, on the small to medium-sized businesses, I absolutely think it's a combination, and possibly for some, Ravi, you're right, probably very, very much helped by the job retention support scheme, the furlough scheme, definitely, and loans, albeit, and I know Roger will know this, and many of our accountants in the room today, albeit many of the small to medium-sized businesses who did take up those early offers of business loans from their local bank, then went on to just pay them back. And it was a case of taking them because we were all acting in a very right, you know, we need to bed down, we need to be resilient, we need to be ready, we need to be able to cash flow. And then as the government support came into being, I know many small businesses have either paid them straight back or are easily paying them back. Anyway, Suren, I note there's a question in the chat around interest rates. So I'm going to ask you just to comment on interest rates, because the question in the chat or the comment in the chat is essentially saying, look, there is going to be pressure on interest rates, definitely, probably not just from inflation, as you've alluded to, but also it's in the government interest to think about, you know, let's hike up those interest rates, particularly in an economy where we've got high debt. So any thoughts on interest rates, or, you know, how does our lobbying, our influencing work around that? And then I promise, Steve, it is over to you.
Thanks, Louise. Yes, just on interest rates. I mean, I think the one thing the Bank of England will look at is not necessarily where the sort of headline figure of inflation. They'll look at, when deciding on interest rates, is what's driving it. Is it a temporary sort of push to prices, or is it more being embedded in people's expectations, for example, and wages? at the moment, and the QS and sort of national QS, they sort of bears this out. A lot of it is driven by what they would call sort of temporary factors, sort of things like, you know, one-off price hikes, for example, and things like steel, that sort of thing. But also, what they also say is they also talk about sort of base effects. So a lot of what we're seeing in inflation is because inflation is comparing this year versus last year. We're comparing almost sort of apples and oranges, really, because last year was a period where we were in lockdown, and obviously that's very deflationary, versus a period now where things are opening up. And so that, again, is distorting figures. But also things like government policy as well. So the VAT cuts that we saw is also distorting figures as well. So there's a lot of noise in that. What the Bank of England will do is actually look through that noise and see what the underlying picture is, and when you take out some of these sort of one-off factors, and I'll look at things like wage growth and overall wage growth. And if that starts to rise, and that will probably increase the pressure on government, on the Bank of England, sorry, to increase interest rates because price and pressures have become more embedded. But as you saw, I said, just going back to QS, as you saw from QS, and again, you're right, we probably stated the Bank of England, pressure from post settlements is actually fairly muted. And that's quite surprising given the increase in price expectations. And again, this is similar to what we saw after the EU referendum, when we saw a big drop in sterling and we saw inflation increase quite significantly, but wage inflation didn't really pick up at the same rate.
Okay. Thank you, Suren. Again, interesting around wage pressures, wage inflationary pressures. I think that will bounce back quite quickly, and I suspect as we move into next year, we will see. I mean, we're already seeing it in hospitality, but we will see some pressure on wages. Suren, that was absolutely brilliant. Hang with us for the Q&A session at the end. I know Sean, who's going to host and chair that Q&A session. I know you're picking up on some of these points, aren't you, Sean, around things like prices of raw materials, hikes in prices, exports. You might want to further explore interest rates. And also something I picked up, Sean, just for a thought, the pressure that Suren noted on our voluntary and charitable sectors. I think we all need to remember that they create jobs. You know, they're as an important part of the economy as anyone else. And yet, as we saw on some of Suren's analysis graphs, they're really under pressure in terms of, voluntary and charitable sector. Okay, Steve, I'll shut up. He thinks that's a good thing. Steve, I'll shut up and hand over to you. Steve Harcourt, Prime Accountant, and they're our local collaborator on our quarterly economic survey. Over to you, Steve. Thank you.
Thanks, Louise. I love these economic breakfasts and the way that we go off at tangents sometimes, and I think I've only got 30 seconds on my slot, but I'll try and fit it all in if I can.
No, you haven't, Steve. Steve, you haven't, because we'll condense Q&A, because I've already started doing Q&A, because I just find it all so interesting. Sorry. So you just tell us. Yeah. Okay,
I'm only kidding. Yeah, we're really pleased to continue supporting the QES as partner with the Chamber. Continue to do that for the rest of this year, and as everybody said in previous speeches, please continue to complete the reports, and it only takes 2 or 3 minutes every quarter to do that, and we want as many businesses to do it as possible so we get a really good picture. I'm from Prime Accountants, a local firm of accountants, so I'm going to be talking about the views of businesses in Coventry and Warwickshire. I'm one of 9 directors in the firm. I'm based out of our Coventry office, taking responsibility for all our client affairs, drawing on expertise of others in the organisation and their specialisms to deliver solutions to meet our clients' specific requirements. So we're looking at trying to simplify a lot of things for business owners at the moment. It's all a bit hectic in certain sectors, and there's a lot going on. We've heard about lots of government funding over the last 12-18 months, lots of clients looking to get into applying for grants, and we've helped them with that along the way, and we've come from a historic economic shock in 2020, record lows from the economic survey last year, the economic index being at an all-time low and the outlook being really pessimistic. as the global economy halted, and a lot of businesses really suffered because they had to shut. As we all know, shops were closed, restaurants, pubs were closed, offices sometimes had to shut, people worked from home, businesses became slightly less efficient, therefore, making things
Steve, you've muted yourself for some reason.
Oh, I don't know how I did that. But okay. Just talking about the economic shock of last year, and that's the low base that we're sort of starting from, going into 21-22, and the economic outlook does look really good from the survey. Confidence is strong and continues to be strong, and we've seen that from the guys who've talked previously. I won't go through any of the numbers because you've seen those already. We're looking to rebound and have a good economic rebound this summer as restrictions ease and everywhere becomes a little bit more open and back to, as I try and hesitate to say, normal. And we're looking at pre-pandemic levels of GDP, around the end of this year, early 2022. So confidence is good. What we've got to see, though, is confidence turn into profits and then turn into growing businesses, and that's really key. And previous questions and answers have already covered some of that, and businesses have really, some businesses have done well, and Roger's client base has obviously done really well. But a lot of the clients that I deal with and a lot of clients that I look after are a little bit smaller than the size that Roger looks after, and there's varying reports over the last few months of how businesses are getting on and what their struggles are and what their opportunities are going forward. So we just move on to a little bit of context in that. And as we've seen or heard, the real issues are with supply at the moment and pricing. Manufacturing really sort of struggling with that at the moment. Delays from what I'm hearing, clients getting imports in from China. Talking to one client the other day who's an online business. They've had a great time selling online, but there's a delay in supply. They think they're about, put it in context, £300,000 worth of sales that they can't deliver at the moment because stock isn't in the country. So there's a real concern that that could sort of hit the business going forward. Hopefully supply chains will start to get back to normal, but there's been talk, as we've seen, of the growing sort of problem with the pandemic and lack of vaccine in other parts of the world. Yes, the UK is doing really well, but other parts of the world aren't so great. So there is an issue there with supply coming in, affecting prices, because really low supply does affect the price of product through supply and demand. I've had clients in the construction sector really struggling to keep sites open because they're not getting materials in. Talking to one last week that said that looking to close a site because they just can't get hold of timber. Now, if you can't go through building or constructing property or converting property because there's a lack of supply of goods, then that's going to really hit businesses hard. They're going to have to cut back. Could be that they have to let go of some of their workforce, or they're just going to have to take the hit themselves in this year's profits. And we've really seen that with manufacturing. And as talking before, the question was raised about, is cash flow due to the increased profitability of businesses? Well, in a way, it's a mixed bag, because I've seen some clients do really well, and that is the case, but then I've seen some that have just about got by, and that's because of all the grant funding they've had and all the furlough payments that they've had. So you're looking at accounts up to the end of March 21. And I know it's historic, but some businesses are just about getting by because they've got their government funding to keep them going through that sort of period of closure and pandemic. There are some businesses and sectors that are really struggling as well. So hospitality, leisure, businesses being closed for such a long time, now reopen. I've spoken to a couple of pubs. We all know pubs, restaurants that serve food and drink been badly hit, but in the recent quarters been able to open and get something near full capacity, which we're hoping they will get in the coming periods. They've done okay. People have come back to eat and drink. That pent-up demand's there, you know, including things like the Euro tournament, the Coventry City of Culture. You know, that will help those sort of businesses. They've got the 5% VAT rate that they're still using up to the end of this year and into Q3, which will help, but then that will be stopped. So as was mentioned earlier, there are various noises in the economy that, you know, when we go back to 20% VAT, businesses are going to see their profits drop because they're going to have to pay an extra 15% over to the Exchequer. So there are businesses that are talking to us about the worries of the additional VAT. Now things are fine at the moment, and things are going well with the way that they've changed the way they work, the way that they've adapted their business with the restrictions lifting and the VAT rates going back up to 10%, the dropout of furlough. You know, we're really looking at helping businesses through those sort of cash pinch points and that are going to be coming up and looking to plan ahead. So it's all about being agile and forecasting and reforecasting to sort of suit a new business model. Lots of other businesses we've seen have been cutting costs, and all those nice to have expenses and overheads have been really cut back, which has helped with cash flow. But as businesses sort of reopen and get back to full capacity, are those going to be coming back online? So those additional costs will ramp up, and therefore they'll be burning through a bit more cash with overhead increases going forward. Hopefully, you know, businesses have sort of adapted and learned how to, you know, drive their business forward without those costs. But there may be a need going forward to you know, see those come back into their business model. Companies that have done really well, I've seen a couple of businesses just go totally online, have had a massive surge in turnover, and such a decrease in cost has meant that they've been really, really profitable. Anybody supplying some of the online retailers, so I've got clients who are supplying Amazon and Amazon warehouses, and companies like that have had a great sort of 2020 and 2021, and it looks to continue as the online retail sort of sector is, or retail sector sort of seems to be going more online. We've seen shops reopen, and that demand has come back to the high street, but that may well drop off again going through into 2022 as more people tend to do their online shopping, and they're a little bit more cautious about going out. We've also, as I said, seen companies make use of the government support. The grant funding that government have supplied has been an absolute lifeline for some businesses, as I said. That funding is being cut now and dropping off as we go through the rest of the year, but there is additional grants for apprenticeships and training that are going to continue, that businesses should be looking at taking into consideration if they're growing their business and growing their workforce, as we've heard earlier. There is a super deduction tax incentive there for businesses that are looking to expand and look at their capital requirements for investing in plant and equipment. This is an incentive that will, for every £100 that somebody invests in a piece of capital equipment, they'll get 130% of that back, £130 back in tax relief, which is fantastic, up to the end of April 23. So there are things in place that the government have already sort of put in place for businesses to grow and invest in the next sort of 12 months. Although there's a little bit of uncertainty still around, you know, what we really need to see is businesses to keep adapting through nobody knows if there's going to be any further restrictions. Nobody knows if there's going to be any disruption to supply chains going forward because of the global picture. People are going to have to sort of change their business plans and their forecasts quite regularly, and we suggest that you continue to monitor that and make sure that when the need is there, that operations do change accordingly. Look at new markets, look at new platforms. As I said before, look at the government funding that is available. There are grants out there for certain businesses. We've had clients in the last month or two looking for a lot more government funding in various aspects for training, and something that will come in from the government if they can get it, that will actually transform businesses going forward, which will be fantastic news. And then getting back to full capacity, hopefully we'll be at a point towards the end of this year where most businesses are open fully and trading as they were pre-pandemic. Everything is, crossed for businesses to do that, which will see businesses grow. And obviously looking at the way that people have changed and been flexible throughout the pandemic, they will probably leave behind products or services that haven't been profitable in the past and move forward with the more profitable, flexible service lines or products that they supply. We've got to make sure that people do make those brave and bold decisions, and thinking about what Roger's saying with the bank and what Lloyds have been seeing over the last 6 months. It really is important that banks do continue to support businesses who are struggling, because I know that there's still some of my clients that are still repaying VAT that they've deferred, and that's an ongoing concern that they're going to struggle to pay that over time. But with the support of banks and with the support of banks-backed loans, hopefully that will be something that they can get through from a cash flow point of view. Really, that's the picture really I've seen at the moment. So there is a lot of optimism out there, but we really got to see businesses turn that into profits and growth, and still a lot of concern about the uncertainty going forward, particularly in manufacturing, construction, with regards to sort of supply chains and price issues due to the lack of supply. So that sort of seems to be the picture from me, and I'll hand back over to Sean for some Q&A.
Thank you very much, Steve. And I think the first question's got to be, one thing we've heard a lot this morning is how the services sector, and particularly the manufacturing sector, have so much confidence now. Is that something you're seeing directly on the ground? Is that something you're seeing from your clients?
The confidence is there. That there are a lot of businesses that are looking to, as I said, that they've adapted over the space of the time that they've been going through the pandemic. They've had to adapt their business. They've had to maybe move online to sell product, or because their shops have been closed, the retail aspect of their business, they're going to have to move online. Pubs, restaurants have changed the way that they deliver their product as well. There's a lot more delivery servicing. There's a lot more outdoor eating, that sort of thing. So lots of people have changed the way that they run their business, and they've realised that. And it's probably come a lot quicker than they probably would have wanted to. It's maybe something they planned to do, but over a period of time, over a number of years, but it's had to happen a lot quicker. So they're confident, but they're still very wary of where are we going to be as an economy or as a country in the next sort of 12 months. And I particularly point out that, supply from places like China is really, really slow at the moment. I've got clients who are struggling to, the orders are there, so the business is good, but they're struggling to actually supply those orders to consumers or to businesses. So there is a real worry that if they can't supply and they can't perform, that those returning customers will not return. They won't return.
I think you're absolutely bang on. What we'll do is we'll bring our full panel up here today. I hope everyone that's on the call has managed to have bring their own breakfast along this morning and enjoy that as we've gone through. Tim Squires, I'm going to bring you in on manufacturing. So we've heard this morning about manufacturing hitting all-time highs in confidence. Sonny was telling us that in his slides. Is that something you're feeling? And is there any Pressures around? Is there any concerns around steel? What's it like doing business in manufacturing currently?
Yeah, hi Sean. Morning everybody. I wouldn't necessarily say confidence is at an all-time high. I think that's a slight exaggeration. However, us as a business are busy at the moment. We have been since we reopened kind of like last June after April and May last year. Obviously, we shut along with all of our customer base. Huge issue for us currently at the moment is what's happened with Liberty Steel. So obviously that where companies like ourselves and other manufacturers have had huge orders, because you put your steel orders in quite a good way in advance, because obviously it's not a quick process to turn around. And all of those orders that have been on with Liberty Steel, obviously when that crashed, the orders were then defunct. So all of our steel stockholders have been trying to work overtime, trying to fill that gap to replace that steel. This then, on top of what the prices are doing in the market, it's made it a really difficult situation to deal with, because we're not talking like small increases. We are talking a ton of steel is now double, sometimes triple what it was a year and a half ago. You know, it's just gone completely mad. And certain customers you can pass that on to quite quickly. It's not a problem. But some of our customers where we are supplying in large volume, and all of their supply base is supplying in large volume, you are talking huge amounts of money that their supply base is asking them to absorb. And obviously, as good purchasers, as good buyers, they're not just going to turn around and go, okay, we'll take it on the head. So that's been tricky in certain instances, but certainly the actual demand is there. But being able to keep up with that demand due to lack of material is obviously an issue. We're seeing our construction customers doing very well. Obviously, people like JCB, they're doing well at the moment. They have done well. Their forecasts through to the end of the year are really strong, really strong, which is great. Niche motorsport and niche motorsport vehicles for the road, people like Caterham, Lotus, Morgan, doing very well. So we may supply them in smaller batches of like 100, 200 parts, and they are consistent, you know, really strong. So that's great. But on the other aspect, getting new work at the moment it's like what we've seen in past recessions, where certain companies have been really hit a lot worse than others. And where the new work is coming in, you're finding these customers, these suppliers that have been really struggling are doing what's known as in our industry buying up the work. So they're putting in prices for the work where they're not profitable on it, but they're doing it just to get work, which, you know, that's not something I'm prepared to do. We don't need to do it. But then growing your business with new customers at the moment is obviously difficult. It's a stupid thing to do, because all you're going to do is lose money and it'll only last so long. But that's what people do, and then hope situation will change. But yeah, really what we could see really would be helpful is that situation with Liberty Steel getting itself sorted, because it's all gone a bit quiet in the press of late. I don't know the government's current stance on it, but it really needs to get itself sorted, because even the steel that we're looking to get in from abroad, it's being delayed at the docks again. So, you know, you're then pushing supply times back even further. But yeah, that's tricky. But in a whole, with demand from our customers, that's strong. So some good, some bad, really, at the moment.
Which I think is reflective in the whole economy. Thank you, Tim. that's something we haven't talked about either, is exports. We haven't managed to bring in that Brexit feel to this economic talk too strongly this morning, which we will do moving forward. Suren and Sunny, Tim there spoke about competition being one of the concerns to his business. Is that something that's been reflected in our QES on a national and local scale?
I think I could pick up on the local aspect. I think I agree in terms of competition, particularly as we go forward and the economy opens up and sectors become impacted by the price pressures that we mentioned earlier. Certainly there is a sense of kind of increased competition, and I believe going forward that I think that will be translated in the coming quarters figures. Yeah, certainly from a local perspective.
And semi on a national level as well. I think we're seeing in two areas. I think it was mentioned around sort of prices around sort of raw materials, that sort of thing, but also around staff as well. Yeah. And this is not necessarily broad-based. I think it is in certain sectors and certain professions as well at the moment, certainly at national level as well. So we're seeing quite a split. Some sectors finding it okay, but other sectors finding real competition for staff, but also to actually get the sort of raw materials that they need.
And I think there's competition on staff as well. We're seeing many firms report to us that they're struggling just to get people on into employment because they've now in furlough, they've moved sector, and they're not willing to come back. Is that something you've seen, Steve, from firms you're working with on employment? Has anybody come to you sort of highlighting that as an issue?
So coming out of furlough, was that, Sean?
Yeah, sort of getting their hands on furlough money, but then trying to turn that into more staff, trying to grow their business from the ground. Is that something you're hearing?
Well, we're not. What we're seeing is people sort of getting back to a level of capacity that they were pre-pandemic, and therefore bringing those furlough members of staff back. There are one or two businesses that are looking to take on new employees, but what we're finding and what we're seeing is that they're looking for skilled people and actual sort of or manager level sort of positions, and they're really struggling to find those individuals. It's really hard, and from our business point of view, we're seeing a lot more people being approached from headhunter type organizations. So I think there's a real lack of skilled and managerial sort of people out there. Not sure whether that's because they're after being either made redundant or being put on furlough for a certain point of time, they've made those life choices of, I don't want to go back into that role and I'm going to go and set up my own business. We've seen a lot of new businesses set up, people who've either taken that sort of choice of I'm not happy with doing what I do in my role anyway, and I'll go and do something I enjoy, finding a niche that they enjoy. I've seen one guy sort of get into second-hand hand tools online, and he's making quite a good go of it. And it just little things like that, and making cast iron house signs, and people are doing things that they enjoyed during lockdown and taking them on. But we're not seeing a huge increase of people coming into a business from a work force point of view. It's more just bringing back those people who are on furlough.
I think that's a good point around SMEs sort of leading the way, and that was one of the key things that helped with the 2008 recession, was more people becoming more entrepreneurial and starting up businesses and really dragging our way out of it.
We're seeing a lot of startups. Yeah.
I think we're going to go to Phil Ingle, and we're going to talk to Phil about interest rates. He's put a couple of questions in the chat around interest rates and the effects on government debt, and I think actually it's a great question to address to the panel. So Phil, over to you.
Thank you very much, Sean. The things we've been discussing this morning, I've just selected a number of things, all of which seem to point in one direction, that with supply chain issues, pressures on wages, possibly due to recruitment issues, maybe led by Brexit and migration pressures as well, interest rates on hold, surely all these things point to a dose of inflation. And inflation, it could be said, is in the interest of the government because it will reduce the real value of government debt. So is this the economic scenario that we've got to be preparing for now? A huge dose of inflation. And I noticed as well, MV equals PT, if I may show my age on my economic thing here. And when we talk about money supply, the anecdotal stuff that we heard earlier on from Roger about cash balances, there's plenty of money about, right? But there's loads of money, but there's shortages of goods. We must be heading for a big dose of inflation, surely.
Suren, is that where we're heading?
I mean, I think the key question, I'm saying this a lot the past year, we don't know ultimately, because what we're seeing in the economy at the moment and what we've seen in the past year hasn't really happened before, where we've had both demand and supply compressed for quite a long time. And as I said, we've had this big bounce of demand, as Phil mentioned, but supply isn't quite keeping up. So that's creating issues like staff shortages, but also inflation as well, and the disruptions to supply chains. And what Phil says is absolutely right. We are in for a period of higher inflation at the moment. The question is how permanent it's going to be. And there's probably a couple of factors that may work in dampening inflation over sort of the medium term. So what we like to see in the UK in particular is the withdrawal of sort of government stimulus, such as the furlough scheme, such as some of the sort of deferrals or these sort of things, which may have an impact in sort of reducing demand. So you may get adjustment from demand supply from the demand side, as well as potential supply side, as supply chains hopefully adjust to what's going on. So that may dampen inflation as well. Also, what might dampen inflation a little bit is if unemployment starts to pick up at the back end of this year as the furlough scheme starts to wind down. That might have an impact on dampening inflation as well. And just last, going to the Bank of England, what they're looking at the moment is not necessarily what inflation is doing at the moment, is what inflation may do in the next 1.5 years to 2 years. Because that's when sort of an impact of interest rate change will impact the wider economy. What they may do actually, rather than increase interest rates, is to reduce their quantitative easing. So this is the other tool to their sort of tackling the crisis. They may do that first before increasing interest rates.
Suren, thank you. And as a Chamber of Commerce, we're meeting with our Bank of England agent in September, and by then I'd imagine the ground would have changed once again. We have come to 10 o'clock. We've come to the end of this meeting this morning. I want to thank you all, you as panelists first. I want to thank you very much for taking the time this morning to come and update our members on what is happening. Steve, what's happening in your business? So, Sonny, what's happening to the economy of Coventry and Warwickshire? And Suren, what's happening across the United Kingdom? Your insights are so useful to us as commentators, to us as business leaders, to be able to go forward and share this knowledge. So thank you very much for your time this morning. To all the delegates that joined us today, thank you very much for taking the time to be with us. We as a Chamber of Commerce really appreciate having such fantastic businesses here as members. Have a fantastic day. I don't like going over time, so enjoy the rest of the day. Thank you very much for joining us, and I look forward to seeing you all very soon. Goodbye.